If you have to choose between a 100% chance of winning $50 or a 50% chance to win up to $200, which one would you choose? Hey, what is up guys? Your answer to the question just now shows your risk preference, whether you like to have income that comes slowly but surely, or you do enjoy some roller coaster experience in order to get a higher return. Looking at the recent news about FTX, Luna, BlockFi, yada yada, that should be a strong signal to you that you should always measure the risk before rewards, and as people always say, do not chase rewards blindly and expose yourself to undesirable risks. Of course, hindsight is 2020. So how aggressive should you be with investing? If you have an answer, congratulations, and stay with me until the end to do the fact check. But if you don't have, also congratulations because you found me. Today, we are diving into the topic of risk. We will sort out your best risk strategy by your ability and willingness to take risks, and you will also be introduced to asset allocation recommendations. And along this video, I will put myself as an example to get you into the scenario. Let's start off with knowing different risk strategies, and depending on the type of investor you are, there are different types of asset allocation recommended. Generally, people can be grouped into 3 different risk profiles: the conservative, the moderate, and the aggressive investor. For some people, they can go to the extent of being extremely conservative or being extremely aggressive, but for the sake of simplicity, we are not discussing those 2 extremes today. Starting with conservative investors, this group of people generally avoid taking any type of risk, nor accept volatility in their investment portfolio. In other words, they need to know it is a guaranteed offer before they would even consider investing. And to some of them, their main objective is to preserve their assets. For example, a retiree who has money on hand but has little to no more earning power, hence he needs to preserve it carefully with low risk investments. And because of that, they usually go for an average return of about 3 to 7% per annum just to beat or stay on par with inflation, normally achievable with fixed income aka bonds and some stocks. Moving on to moderate investors, people in this group get the good from the both worlds. They chase some gains but at the same time also intend to protect their capital. They try to reach a great balance between risk and return, looking for a return between 7% to 9% every year. A really good benchmark here is the S&P 500 that has returned for about 8.91% per annum for the last 20 years. And lastly, we have aggressive investors. They are the investors that are most heard of because they can earn big and lose big as well. Basically, as compared to the other 2 groups of investors, aggressive investors are usually and hopefully more experienced investors who have a deeper understanding of securities. So the main goal here is to grab the reward as high as possible, normally 10% or more even if it means more risk to them. And here is a fun fact: study shows that women tend to be more conservative than men when it comes to investing. What do you think? Is it true? Maybe let me know in the comment section down below. Now we know there are 3 profiles, but how do we know which one we belong to? Well, your risk profile is decided based on 2 factors: risk capacity and also risk tolerance. Risk capacity talks about how much risk you can afford to take, while risk tolerance is about how much risk you really want to take. Let's start with risk capacity. There are a lot of factors, but in short, they are your age, time horizon, the size of your investment portfolio, and your income. Speaking about age, younger people simply can take more risk than older people as they have more time to earn back their money. Just imagine if you are in your 50s and all your capital is in a few selected stocks. All it takes is one huge market crash and you may just have to say goodbye to your retirement.
The Dow Jones Industrial Average dropped more than 900 points.
And also, a younger age is a prerequisite for having a longer time horizon, the second factor of the risk capacity. This is about how long you want to commit to your investments. Do you have any plan to take the money out soon? If you put say $10,000 into the market today, knowing that 1 year later you will use the money to buy a car, it is better for you to just go for a lower risk investments to avoid any volatility. According to Morgan Stanley, if your investing period is less than 3 years, it is considered short term. Between 4 to 10 years, it is medium term, and anything more than 10 years is considered as long term. Again, the longer the horizon, the higher the volatility you can take. Moving on to the next one, the size of your investment portfolio. Say you have a larger pool of money, it is easier to do proper asset allocation with enough diversification. We all know a way to reduce risk is not to put all eggs into one basket, but with a small portfolio, there is only so much you can do, right? Unless you have access to fractional shares through interactive brokers, If not, you will end up paying more fees to the broker than gaining any sort of sizable return. Now we are done with the size of a portfolio, but let's not forget that your income also plays an important part. The amount of income and its reliability from sources other than your investment portfolio determine your risk capacity too. So having a secured job with higher income will of course put you in a better position. Touch wood, but if you ever lose your investment, you know the income will support you. A good thumb rule here is to fork out at least 10% of your monthly income for investments. So by combining the 4 factors, you should have an idea of your own risk capacity. If I were to use myself as an example, I am 27 this year, and that means my investment horizon is probably at least 10 to 15 years long before I retire or be financially free. And because I have a pretty stable income source with healthy increments and career growth, plus I have this YouTube business at the side, I will have more cash flow than the average person, which means I'm able to take more risks since I can just buy more shares for the long term without worrying about the short term needs, right? But that's me, and like I've said, everyone's situation is different, so you probably have a different risk capacity compared to mine. So that's risk capacity. On the other hand, your risk tolerance is more closely tied to your emotion, and if you are the type of person who gets extremely stressed out when the market goes down by say 10 or 15%, then this may be an indicator that you have a lower risk tolerance. There's nothing to be shy about that. The last thing you want is to let ego get in your way. For some people, 0% return is better than negative 20% return. Makes sense, right? There is a really great test out there hosted by University of Missouri, and you should definitely try it out. I'll put the link down in the description box below for you. It is an easy and fun test that asks for your personal finance knowledge and gives you some situations, and you will make your choice. Then based on that, they will tell you how your risk tolerance is. I personally took the test, and here is my score, 27, which falls under the category of moderate risk tolerance. I guess this kind of makes sense. As you can tell, I normally avoid speculative or meme stocks or just any hyper-aggressive growth stocks like small to medium cap stocks, as they do not have much valid justification to maintain their price and are very prone to market manipulation and economic headwinds, etc. Plus, my target annual return here is around 12 to 15% per annum. But at the end of the day, 8 or 12 or 15% is just an arbitrary number. Use that as a guiding principle as opposed to a hard target to achieve. So finally, we have everything on set. Now match your risk capacity and risk tolerance, and tada, that is your overall risk profile. If you have either low risk capacity or low risk tolerance, you are recommended to be a conservative investor. Meanwhile, if you have high risk capacity and at the same time a high risk appetite, join the aggressive investor clan. Anywhere in between, and you are most probably a moderate investor just like me. Enjoy the benefits from both sides. So here comes the magic of asset allocation. Assuming that I am a super aggressive investor, Investopedia recommends 80 to 100% equities or stocks, 0 to 10% fixed income securities like bonds, and keep 0 to 10% as cash. And with the same risk profile, Merrill, on the other hand, thinks it would fit me the best to have 88% stocks, 10% bonds, and 2% cash. Meanwhile, Fidelity would suggest 60% US stock, 25% foreign stocks, and 15% bonds. There are other types of model of asset allocation too. Goldman Sachs distributes asset into equity, fixed income, and cash, and each varies depending on your investment time horizon. Our famous investor Warren Buffett also has a well-known principle known as the 90-10 asset allocation. 90% in stock index funds such as S&P 500 ETF, and 10% in lower risk instruments like government bonds. Other than that, you may have also heard of the 110 minus your age equals to the percent of the portfolio that should be in equities. For example, since I'm 27 years old, then I probably should have 110 minus 27 equals to 83% of my portfolio in stocks. And yes, this is also one way of doing it, simple and quick, but do be mindful that it takes your age as the sole factor. But wait, remember, this is not forever. Your risk profile is dynamic and is likely to change with time. You might get a promotion next month, or a wedding to plan in a year's time, or you might get retired in a decade or two. Hence, you are more than welcome to revisit this video and update your risk profile. Well, all said and done, I hope you now have a better understanding of your own risk profile and allocating the correct weightage for your investment portfolio, especially for your stock portfolio. Do comment down below to share if you are a conservative, moderate, or an aggressive investor. If you are ready to start investing, definitely check out my 2 personal choices of brokerage accounts, Interactive Brokers and Momo. I have their links down below for you. With that, thanks for watching, and as usual, I will see you in the next one.